Hey y'all, so today I'm back talking to you about how to make more money like millionaires do. And I have another article. This one's from CNBC, Delivering Alpha. I'm sure you heard of it. Had to make some edits in there, got some pictures in there. Looks pretty good. It's really useful information. This one is discussing the 10-year treasury yield. So I'll just read the title. It's called Delivering Delivering Alpha, and these are on CNBC. Anyone can find them. This article is called "This is the level where the 10-year treasury yield becomes a clear issue for stocks." So I have to edit some words here, mark out some of people's names because I don't know what they are, so I'm just not going to make too many references to them. But for stocks, and this is what a financial firm study shows. So I'll go through some of the information on here, like here. So the volatility in the bond market has had equity investors on their toes for months, but what point will rising yields spoil stocks? 2024 rally, question mark. Then or then? The answer is 5% on a 10-year treasury yield. According to a finance firm, in a new 19-page paper using market data since 1980s, the firm said that when that threshold is reached, the correlation between bond yields and stocks turns negative. While there is no magic, so in quotes, while there is no magic number, comma, historically bond yields at around 5% is when higher yields become a clear problem or issue for equities. M dash. That is the point where the correlation with bond yields is no longer decisively positive. End quote, comma. Wrote a team of strategists led by a chief global equity strategist. So it goes on to say the benchmark 10-year yield jumped 5 basis points Tuesday to 4.67% after data showed employee compensation costs increased more than expected to start the year. It marked yet another sign about persistent inflation, which is the increased cost of living. That's what they call inflation, which the market thinks will keep the central bank on hold until later this year before it starts to consider cutting rates or reducing rates. A basis point equals 1/100th of a percentage point. So 100 basis points is equal to or equates to 1%. The way most people know. So moving on, we get a graph of the 10-year treasury yield. So this is just for United States Treasuries, 10-year, 1-year change. So you can see it goes up to 5%. It's talking about from May 2023 to March 2024. Have a look at the data there. Pretty interesting graph. So it goes on to say the finance firm said investors are currently in the optimism phase, quote unquote, of the cycle where confidence and complacency grow, pushing valuations higher. So in quotes, equity valuations are higher and the cycle is more mature. So equity markets are very sensitive to moves in bond yields. Quote, that's someone from a firm said. Then they go on to say, they underperform with yields moving much higher around news of overheating and higher inflation, while they outperform when the market prices central banks to reduce interest rates. So the 10-year treasury yield, a key barometer for mortgage rates, auto loans, credit cards, has risen almost 80 basis points this year as the market adjusts to a higher for longer rate regime. The current rate on the central bank's funds for overnight lending is around 5.25%, 5.50%. This is like April, May 2024. Shit, the date there. This thing can focus. Anyway. Around that time, 2024, May. And then after starting the year forecasting at least 6 reductions in interest rates, The market is now pricing in a 75% chance of just one rate cut, according to one company's widely followed tracker that derives its probabilities from where 30-day fund futures are trading. The central bank's rate-setting Federal Open Market Committee began its 2-day stint, where big money investor names has long stressed the impact of interest rates on all investments, saying higher rates exert a huge gravitational pull on asset values, lowering the present value of any future earnings. Rising yields dent the appeal of risk assets as shorter dated treasury bills and longer dated treasury notes offer solid yields and a risk-free alternative to stocks. And then it goes on to the next, has some more articles that you refer to. The next one in this delivering alpha, something to do with the stock market. But yeah, it's this is an interesting article. You can find these on CNBC. This one's talking about the 10-year treasury yields compared to stocks at this current time. I'm not sure how many of y'all invest, but no, it's always good to know what the returns and levels are in certain types of vehicles, in certain types of asset classes. And this one talks about the 10-year treasury yield. So I'm sure many people are familiar with this and they invest in it. But compared to stocks, right now or currently, at this time, it's in around 5% from May 2023 to January 2024. You could probably do better with some certain types of stocks, lower risk, depending on what your investment criteria is and what you're going for, what you're trying to achieve. There are probably alternatives out there that are superior and better than what the treasury yields offer. But this is one interesting topic. So I'll probably go through these delivering alpha articles a little bit more. There's some good information on there. I hope you find this useful. Let me know what you think in the comment section if there's something you want me to go through, and I'll try and make some time for it. Until next time, have a good one. Thanks for tuning in. Have a good one.